On January 28, 2013, an importer customer requested a bank to remit Singapore dollar 25 lakh under an irrevocable LC. However, due to unavoidable factors, the bank could effect the remittances only on February 4, 2013. Interbank rates are given to you as follows on 28th of January and 4th of February. Okay, so the bank was supposed to remit Singapore dollar to the customer, to the importer basically, who is the customer of the bank, 25 lakh Singapore dollars on 28th of January. But the bank is doing it on 4th of February. Okay, so then we are asked, see what is asked in the question, required is how much does the customer stand to gain or lose due to the delay. Okay, customer's point of view is if he has to pay more on 4th of February to the bank to get that STD dollars, then he's at a loss. Otherwise, if he pays less on 4th of Feb then on January 28th, then he gains. Okay, it's simply that way. So let us solve the solution. Before that, see one more thing. The bank wishes to retain an exchange margin of 0.125%. That we'll see when we calculate the code. Okay. The first thing we see is which are the two main currencies involved in this particular contract. See, one you have STD, which is clearly given, but against what? So the importer is going to buy STD, the bank is going to sell STD, but against which currency? The other currency is not given to you. So we can find that from the quotes given. See, it's very simple. $1 is equal to rupee something, 1 pound is equal to dollar something, and 1 pound is equal to STD something. If you look at these three codes carefully, you would see that, I'll change the highlighter color here. See, there is a common pound code, so pound cancels out. There's also a common dollar code. This will cancel out. Finally you are left with rupee and STD. So the two currencies involved here is STD and rupees. Now how do we proceed further? We start with the solution. See, the customer, in this case the importer, he is Indian because if you see the other currency is rupee. Okay, he will buy. Okay, he will buy from the bank what? By what? STD, Singaporean dollars. Okay, 25 lakh. Why? To pay off the shipment that is coming, the import order. Okay, so basically he is buying, so definitely the bank will be selling. Therefore bank, or you could rather say debtors, bank sells to customer SGD 25 lakh, right? Bank will earn spread. Spread means what? Ask minus bid. So this is basically the profit that the bank earns while buying and selling foreign exchange. Okay, so bank will always sell high and buy low. Okay, and customer is the opposite. Customer always buys at a higher price and sells at a lower price to bank. Okay, now the code that I have is, see, STD is one currency and rupee is another currency. Okay, so we have rupee by STD code. Okay, this is what we need. So since the bank sells at high and we are selling, see, bank, we as in the bank, okay, the bank sells to the customer at a higher quote. So therefore this rupee by STD will be ask is high and bid is the lower rate of the quote. Okay, so how do we get this? Numerator has to be rupee, denominator has to be STD. Okay, but instead of two quotations here you are given three. So let's see the common currencies that we have to adjust and put it in such a way that they are cancelled out. We have two common currencies, we've seen this. See, dollar is one of them and pound is one of them. Let's see, rupee and dollar. This is a direct dollar code because dollar is in the standard currency. So this is rupee by dollar. So rupee in the numerator, yes, dollar in the denominator. Great. Then to cancel this dollar out, we need dollar in the numerator. Let's see if we have a dollar by STD code, a direct STD. we don't have that code. So what we'll do here is we have to adjust. We see the codes and then adjust this. Dollar by pound and finally pound by SGD. So if you look at this, rupee is in the numerator, SGD in the denominator. This dollar will cancel out against this one, and this pound will cancel out, numerator and denominator. That is how you frame a code, okay, this way. Now let's see if we actually have these codes or we have to do inverse in case we don't have them, right? This is the ask because we've seen why, because bank sells at high and bank is selling SGD, okay, this one. So rupee by dollar, do we have? We have that. See a direct dollar quote. Okay, so first see, I'm just doing January 28th. Similarly, you have to do February 4th and then compare both of them. So first we are only focused on January 28th. We are given two rates, the bid and the ask. So which one do we select? The ask rate, the higher rate, this one. Okay, because a direct dollar quote, the higher rate. Okay, which was the rate is 45.90. 45.90. Great. Now dollar by pound, do we have that rate or not? Let's see. No, we have a pound quote. That means, what do you mean by this? This is pound quote is dollar by pound, a direct pound quote. See, the pound is in the denominator. More importantly, pound is in the standard currency. 1 pound is equal to dollar something, 1.7840 and 1.7850, but 1 pound is equal to, right? So this is a direct pound quote. And do we need a direct pound quote? Yes, fortunately we need a direct pound quote. So this has to be ask, this is also ask. So higher, so we take 1.7850 into 1.7850, and then we need a pound upon STD code, that is a direct STD code. Do we have that or not? Let's check it out. Unfortunately we don't. We have a direct pound code against STD, so we have to take inverse. Now when you take inverse, like for example the original quote here, see, the original quote here is pound by STD, a direct STD quote is ask, the higher price, right? But in case of inverse, the rate also changes from ask to bid. It's the opposite rate. It's actually mathematics, but we are not going into that right now, why it changes. I'm just saying this, that when you do the inverse, see, this dollar pound by SGD, 1 by pound by SGD becomes SGD by pound. But instead of ask, now you have to take bid. Bid is the lower quotation, a direct pound quote, 3.1575 or 3.1590, the lower, 1575. So this is 3.1575. We calculate this. So this comes up to 259482. Okay, now what? The currency is extremely important. So see, I'll write the currency here. This is rupee by dollar. This one was dollar by pound, and this we've already done. Okay, so this entire thing is SGD by pound. Okay, so no, see, there is a mistake here. Let's see the final code. What was that? A direct pound code. A direct pound code is given to us, and we want a direct SGD code. So here, see here, by writing we just made this mistake. It's a direct pound code, so pound comes into the denominator. This is SGD upon pound. Okay, and this bid is correct. Bid. Okay, so wait, let me write this clearly so then there is no confusion. Just wait. See, this is, once again we'll write rupee by dollar 45.90 into dollar by pound 1.7850, and this comes in the numerator, pound by SGD, that is 1 upon 3.1575. Okay, this way. So now you cancel out the currency. Dollar goes, pound goes. Finally, you are left with something that you need, rupee by SGD. We already had calculated the amount was, I think, 25.9482 maybe. Okay, but what? Rupee by SGD. Okay, this is what we need, correct? So you can also write this as 1 SGD, because SGD is in the standard currency, is equal to rupee 25.9482. This is just presentation. This is your code. One more thing, see in the question we are forgetting one more thing. The bank wishes to retain an exchange margin of 0.125%, right? Retain. When will the bank retain this margin? See, when the bank sells, the bank will always sell at a higher price. Higher price is extreme high price, like the base ask plus the exchange rate. Okay, use your common sense. See, when the bank is selling, it wants to make the utmost profit it can make. So your ask plus the extra margin also they will add. In case the bank buys, so the bank buys at a lower price, the lower quote, that is the bid rate, but it has to pay even lower than that. So then the margin is deducted. Okay. In case of sell, the margin is added because the bank wants to get higher profit. Okay. So what we do, this is your quotation, but on this also the bank wants more profit, the exchange margin. So add the exchange margin because it's the sell rate. Exchange margin, I think it was 1.125%. This comes up to, calculate it, 25.9482 plus 0.125% gives me 25.9806. Okay, this is again 1 SGD is equal to rupee. So this is your final rate. This is the rate that the bank will quote, that okay, at this particular rate I am willing to sell you 25 lakh SGD, Singaporean dollar, and in return of rupees. Okay. Now similarly you have to calculate it with the cross rates. Use the above concept of cross rates and calculate the rate and calculate rupee by SGD rate, plus do not forget this exchange margin. Okay, plus the exchange margin, which will then give you the final rate. The only difference now is this is on 4th of Feb. Okay, similarly you have to do, everything is same. So right now we'll just fast calculate this quickly. We'll do this. See, the same rates you have to take. This one, the same, selected on 28th of January. Similarly we'll take, or if you want to do it all over again and understand that, for that you just rewind the video. We'll right now just calculate this one and this one. Okay, so 45.97 into 1.775. so equal to 45.97 into 1.775 into 1 upon, what was the third rate, 3.1380. This is the bid rate, 3.1380. Okay, the currencies I have not written because if you cancel out, it will be similar as what we've done earlier on 28th of Jan. This will be 1 SGD. Calculate this. This comes to 23.0394. But this is not your final answer. Please do not make this mistake. This is 1 SGD is equal to rupee. You have to add the exchange margin. The exchange margin that the bank will retain, which is 0.125%, which comes up to how much? Plus 5%. The final answer comes to 23.06. Wait, there is some mistake here. So we'll calculate this rate again. 45.97 into 1.775 775 divided by 3.1380, 26. See, minor mistake could lead to lose of marks. 26.0394. Okay, now it's correct. Now on this I'll add 0.125%. So this gives me 20. This gives me 26.07196. Okay, now what is this? 1 SGD is equal to rupee 26.01796. Okay, so this is the rate, final rate on, but which date? This is on 4th of Feb. At this particular rate, the bank will sell to the customer SGD 25 lakh. So now see whichever rate is higher. If the rate, let's see the other rate. Let me highlight. This is the rate 25.9806 and this is 26.0719. So obviously on 4th the customer has to pay more. Okay, so the customer is at loss. So therefore the customer is at a loss since he or she has to pay more rupee to get SGD 25 lakh. Okay, which at the rate this is 1 SGD is equal to rupee 26.07196, because finally he's paying at 4th of February, right? So you can write it that way, and then you can also disclose the difference of what is the profit and loss. So that is also something that can be done. If you want, we'll do that also, because it's just one line. This much we've done, but we need some space, so let's do here. Let me take the rate. 1 SGD is equal to rupee 26.07196. Okay, we just need 4 decimals, so this much would be okay. So okay, this is on 4th of Feb and this is on 28th of Jan, the final rate after adding exchange margin for the bank. So how much loss for the customer? Here, see, I'm writing. Let me decrease this. Okay, loss to importer would be how much? Initially the exposure was 25 lakh. Here, see, 25 lakh SGD is what he wants, and for that he has to pay extra of how much? 25 lakh SGD. Extra is 26.0719 minus 25.9806. 26.0719 minus 25.9806 into 25 lakh. This comes up to 2,28,250. Correct? This much rupees he has to pay extra. So this is basically loss to the customer or the importer. Okay, bye bye.